Intro to Accounting. It's our last unit, Chapter 8. Well, I guess we have 2 units in Chapter 8, but it's pretty close, right? We have 8.1 and 8.2. Let's jump into 8.1. We're going to record some closing entries here. We're so close to be 100% done with an accounting cycle. Let's look at the one learning objective that we have today is journalize and post closing entries for a service business that's going to be organized as a proprietorship. So journalize and post some closing entries for this service business. So let's jump in. One of the things that we haven't really talked about ever, because it hasn't come up until this point, is permanent versus temporary accounts, which is pretty much referring to some of these accounts that when we get done with our accounting cycle, we're going to need to, in a way, like empty out some accounts, bring it down to 0. And we're going to use temporary accounts to do that. So it shows here, it says the worksheet is going to be used to complete other end of period work. So we're still going to be using that worksheet that we did in Chapter 6 to complete this work that we're going to go ahead and do. Accounts used to accumulate information from one fiscal period to the next are called permanent accounts. Permanent accounts are also referred to as real accounts. Permanent accounts includes assets, liabilities, and owner's capital. Let's put this in a perspective for 1 second. A permanent account is going to be something that even at the end of the year, the end of our financial year, let's say that's December 31st, we don't just lose all of our assets when we roll over to January 1st. Right? Our assets don't start back at 0. Our liabilities, any money that we still owe somebody after December 1st, then it goes to January 1st. We don't just not have to pay any of those people back, right? Those are called real accounts. They're permanent accounts. They're going to carry their balance over from 1 year to the next. And of course they would, right? The same thing with our owner's capital account. The owner still has that same amount of capital in the business. It's not like it's a 1 year thing and then everything disappears. So the permanent accounts are going to, the ending permanent account balances, let's say on December 31st, will be the beginning account balances for January 1st. So those are permanent accounts. Now we have the opposite of that. Accounts used to accumulate information until it's transferred to the owner's capital accounts are called temporary accounts. Temporary accounts are also referred to as nominal accounts, and this could be our revenue, our expenses, owner's drawing, and the income summary account, that account that we have not done anything with yet, but it's going to be a very, very important tool today. So temporary accounts, if you kind of think about it, here's owner's capital, okay? Here, it's like the giant Pac-Man. And all those temporary accounts get eaten up by our owner's capital accounts, okay? That's what happens. It gets eaten up and it gets absorbed into that owner's capital. Because things like revenue and expenses, when the fiscal period is over, I'll just keep using December 31st, we want to make sure that these balances get reset back to 0. Why? Because we can't have sales that carry over from 1 year to the next or expenses that carry over from 1 year to the next. That'd be pretty silly, right? Like for this year, I have all these supplies expenses. That was my phone. I hope it still works. That was my supply. These are all my supplies expenses, right? And from 1 year to the next, I'm not just going to say, okay, last year I had $100 in supplies expense. I'll just carry that over. And this year, when I buy pens for the first time, I'll now have $110 in expenses. No. That's not how it works. Those accounts all need to start back at 0. And all those accounts will be summarized, and they'll all affect the owner's capital account. Obviously, if it's expenses, it's going to bring owner's capital down. If they're revenues, they bring it up. So we need to bring those temporary accounts down to 0 when we come into a new fiscal period. So the need for closing these temporary accounts, we're going to have journal entries, and they're going to be used to prepare those temporary accounts for the new fiscal period, and this is going to be called closing entries, which essentially means that temporary account has a balance, and we are now going to perform a closing entry so that balance goes down to 0. The procedure prepares the temporary accounts for recording information about the next fiscal period. So all temporary accounts should start the new fiscal period with 0 balances. That's the goal here. That's what we want to do. To close a temporary account, an amount equal to its balance is recorded in the account on the side opposite to its balance. For example, if an account has a credit balance of $3,565, a debit of $3,565 is recorded to close the account. Okay, let's break it down for a second. If we have, let's say, revenue, which has a credit balance of $150, how do we bring that account down to 0? Well, we just debit it $150. We take the balance, and if it's a debit balance of, let's say, $100, we credit it $100 because then our new balance will be 0. So all we do is we look at that balance and we debit or credit whatever side it is on that same exact amount. So we're bringing those accounts down to 0. When we look at it like that, it makes the following steps a little bit easier because we go, all right, my supply account has a $100 credit balance. How do I bring it down to 0? I must debit it $100. And that's what we go ahead and do. All right, now we get into this income summary account, the thing we've been passing over on that worksheet for the last couple chapters, and just go, don't worry about it for now. Now we get into it because the income summary is very important when it comes to closing out temporary accounts. So if we look here, the temporary account that's titled income summary is used to summarize the closing entries for revenues and expenses. So our revenues and expenses, you guys remember when owner's capital was the giant Pac-Man, right? I forgot what side it was, and it took everything else. Well, what happens is income summary, first, before that owner's capital is affected, income summary is going to eat up our revenues and it's going to eat up our expenses. And income summary is going to be used to hold on to that. That's how we kind of look at it. So the income summary account is unique because it doesn't have a normal balance side. The balance of this account is determined by the amounts posted to the account at the end of a fiscal period. When revenue is going to be greater than total expenses, resulting in net income, that's what it is, right? When revenues is more than expenses, we have net income. The income summary account will have a credit balance. Okay, it's going to have a credit balance. When total expenses are greater than revenue, or we had a net loss, the income summary account has a debit balance. So in a sense, it's going to have the opposite. Just look at it like this and look at it from here. We don't have to get into too deep, right? We just need to remember that. So the income summary has a credit balance if revenue is greater than expenses, and it has a debit balance if expenses is greater than revenue. And you'll see why as we kind of go through the problem. So thus, whether the balance of the income summary account is a credit or debit depends on whether the business earns a net income or incurs a net loss. This income summary is a temporary account, and income summary itself is going to get closed. So when we look at the 4 closing entries, we have an entry to close the accounts with a credit balance. Okay, that's probably going to be our revenues. An entry to close income statement accounts with debit balances. That's probably going to be our expenses, and then an entry to record net income or net loss and close income summary. So what that means is we're going to actually close income summary as well, and then we'll close out the owner's drawing account. So we'll have revenues get closed, we'll have expenses get closed, then income summary, since it's done its job, we close that because it's temporary, and then we'll also close capital. Okay. So our sales, which will have our sales here, which has our credit balance from our worksheet. Well, here, I'll scroll down a little bit. It says Delgado Web Services has one income statement account with a credit balance, and that is sales. So our credit balance account that we look at back here, right, that we need to close, the credit balance is our revenues, okay, our sales. And Delgado Web Service only has one of them, right? And it's just going to be sales. If we looked at our income statement, that's what's on our income statement worksheet. You guys have been looking at this already. This credit balance must be reduced to zero to prepare the account for the next fiscal period. To reduce the balance to zero, sales is debited for the amount of the balance. Because debits must equal credits for each journal entry, some other account must be credited. What other account is going to be credited? Well, that's going to be the income summary. The income summary, once again, is just going to be eating up all of our revenues and all of our expenses. So when we look here on our worksheet, sales has a credit balance. And because it has a credit balance and is temporary, we're going to need to bring sales to a zero balance. How do we do that? How do we do that with a T account, right, that has a credit balance of $5,820? We debited $5,820. So that's what we're going to do here. And we do it, we have a couple steps. The first thing is we're going to journalize this. So we're going to write the account title here, closing entries, or our heading here of closing entries, because we're going to write a couple closing entries. Okay, we're going to close out our credits, we're going to close out our debits, and then we're going to close out income summary and drawing. So closing entries, we're going to put the date here, and then we're going to put the account that's debited first. What account is debited here? Sales is, because remember, the goal is to bring sales to a balance of zero. Income summary is going to be credited. Now, when you look at this income summary, all it's doing is the opposite of the close. It's just the opposite of whatever we have to do to close out our sales account. So sales must be debited. So income summary must do the opposite of that. It must be credited then. So if we looked at sales right now, and we go down here, sales had a balance, a credit balance, $5,820. We close it by debiting it, $5,820, and now the new balance is zero. Sales is officially closed, and income summary being credited, $5,820 has now, it's done the Pac-Man, right? It's absorbed our sales. So the balance is now zero, and when we roll around to the next fiscal period, the balance of sales will be zero, which is awesome. And that credit balance of sales is transferred over to income summary. So you can see here, just going through the steps. So that's our first thing that we're going to do. Next, we're going to skip past that. And we're going to skip past that. Next thing we're going to do is we're going to close our entries from our income statement accounts with debit balances. Now remember, this is our worksheet and it's our income statement. So now we're going to close out anything with a debit balance. What's on our income statement? Revenues or sales and expenses. What are all the debits? They're all the expenses, okay? And this one's a little bit trickier, but essentially what we're doing is we're going to close all of our income statement debit accounts, which are our expenses. Here we have 7 expense accounts. So if they all have debits and they all have balances here, how do we bring them all down to zero? Well, we're going to credit them all the balance that they have as a debit. So advertising expense would be credited $3.97. Cash short and over would be credited $1, and you can see that down here, okay? Same exact thing. And once again, income summary is going to eat up all of our expenses now. So we write the date, and we're actually going to write the amount that's debited first. Now, income summary will need to be listed first. How do we come up with this number, the 2,658? Well, that's all of our expenses added up. So it should be, we go ahead and we're going to add up the 397 plus the 1 plus the 80 and so on and so forth. And all of these expenses will add up to 2,658. And we're not going to write income we're not going to record on our closing entries like income summary, advertising expense, cash short and over, income summary, communication expense, income summary. It'd be pointless to do. So we're taking all of the expenses and we're debiting that amount. Okay, and we're debiting that amount into income summary. So at the end of this, all of these accounts, all of our expense accounts will be at zero, and our income summary is going to absorb their original debit amount. So if we look down here, you can see that all of these accounts, not income summary, but all the expenses will be close and their new balance will be zero. Income summary now is going to be debited 2,658. You can see here, if we just pull this up, it's not really zoomed in, but if you look at this income summary, we now have the revenues, which was credited at 5,820, and the expenses, which is debited at 2,658. The new balance here is 3,162 on the credit side. And what's this equal? That's our net income, right? That's now the net income amount has successfully been transferred over to our income summary. So now what we do is we pretty much get rid of income summary. Income summary was an awesome little Pac-Man that got our expenses, that got our revenues. Good job, income summary. But now you have done your part, you have served your duty. Now I need you to go, okay? So when I look at this, it can get a little bit confusing here, but it says Delgado Web Services net income appears on line 21 of the worksheet. The amount of net income increases the owner's capital and therefore must be credited to the owner's capital account. So the balance of the temporary account income summary must be reduced to zero to prepare the account for the next fiscal period. So what does that mean? They kind of show the debit of net income here. They kind of make it a little bit hard to follow. This is what I want you guys to look at here. What's the balance? What was the balance of income summary on the last problem that we looked at? Okay, what was it? It was 3,162, right? And it was a credit. So if we go back, now our goal is to close out income summary. How do we do that? Well, the way that we're going to do that is we're going to debit it because it has a credit balance of 3,162. So we're going to debit it by 3,162. We are now changing Pac-Mans, right? And we're taking that Delgado Capital. Delgado Capital is now eating up income summary. That is what is occurring here. So income summary is going to have a balance of zero. And then Michael Delgado's capital is actually going to be positively affected when we credit it. Okay, right? It's on the right-hand side of the accounting equation. It's capital. It increases with a credit. And we credit Michael Delgado's, we could just look at it and go, income summary must be debited, so Michael Delgado's has to be credited. That's fine. You can look at it that way. I just want to explain the reason why behind it. We had more revenues than expenses. So our income summary had a credit balance. Now, this is right? That's good. That's what we want. That's technically our net income. So now at this point, when we close out our income summary, we debit it, and Michael Delgado's capital has to be credited. When we credit it, it's actually increasing that capital. It's doing the same thing that you would think net income would, okay? Because we had more revenues than expenses. If we had a net loss, these would be flipped around, okay? Income summary would have a debit balance and it needs to be credited, and then Michael Delgado's capital would actually go down. So that might have been a bunch of mumbo jumbo when you're hearing it and you're like, I just need to remember income summary needs to be brought down to zero and Delgado's capital is going to do the opposite. If that's the case, that's fine, as long as we get through it. So you can see now income summary has a new balance of zero. Michael Delgado's capital is going to be increased by 3,162. Looks like it already had a balance of 2,000, so the new balance is 5,162. It says here if it was a net loss, it'd be a debit to owner's equity or owner's capital. Okay. So there we are. We've now closed out all of our revenues, all of our expenses, and our income summary account. One more thing to do. We're going to close out our owner's drawing. And when we look at owner's drawing, what do you think owner's drawing does to capital? It's going to decrease it, okay? So that's the why behind why we're doing this here. We need the drawing account to be reset to 0, and it's going to decrease our capital. So we'll look at our balance sheet here. So once again, this is on the balance sheet. This is a little bit different, but it's just the drawing account. What balance does the drawing have? It has a debit balance. So what are we going to do to make our drawing, to bring our drawing to 0? We're going to credit it the same amount. So when we write this out, we put the date. We know that drawing is going to be credited. So we're still going to use Michael Delgado's capital. Michael Delgado's capital is our ultimate Pac-Man, the one that wins in the end. And Michael Delgado's capital is going to be debited. It's actually, the capital will be decreased technically. And Michael Delgado's drawing must be credited to bring that account balance to 0. And you can see here, Michael Delgado's capital will have a debit amount affected to it. It's going to bring that balance down. And then Michael Delgado's drawing is being closed at this point. So that is it. What we're doing here is we're journalizing, and we will post those closing entries, but we're taking the income summary temporary account and we're using it to close revenues, then we're using it to close expenses, and then we're taking the capital account, right? The capital account now will eat up our income summary and it eats up drawing, and all of our temporary accounts are closed. If you have any questions, let me know on that, but let's jump into the work together and on your own. All right, so now we are on the 8-1 work together. I might only do the beginning portion of this because the second part is posting closing entries, which you guys have done a bunch of times before, and it's a little bit time consuming. So just to save some time for you guys, I might make the executive decision. Let's see how long this video goes. But you can see here, it says the completed worksheet for Fix It Now for the month ended April 30th of the current year. And it's given in the question assets on page 8 of the general journal provided. Journalize the closing entries. So here, we're going to put in the 30th. We're going to start with the date. And our main goal is going to be to close out a couple different things here, right? Our revenues, our expenses, and use our income summary for that. And then eventually close out our income summary as well and our drawing. So let's start and go to our income statement. The first thing that we have is sales. And sales has if we look at our income statement, we only have one credit account. And we need to close out credits to start. Let me show you that. Make me tiny. All right. Okay. Income statement. There we go. 2160 is going to be the only credit on that income statement, and that's sales. So if it has a credit balance and I need to take sales and I need to bring it down to 0, what am I going to do? I'm going to put in sales here, and I am going to debit that amount. So I'll debit my sales by 2160. And what's absorbing those sales? What account? Income summary is. So then income summary will do the opposite. It's going to be credited 2160. So that's all the credits that we have here, which is kind of nice, right? It's all done. So let's put in our next entry. And now we're going to close out all of our debits that are on all of our debits. Let me see how far over that are on our income statement. And here it looks like we have 1, 2, 3, 4, 5, 6, 6 different expenses that are all debits on our income statement. How do we close those out? Well, they're debits now, so we need to credit all of those accounts their current balance. So let's go ahead and do that. I'm going to just write I'm going to write income summary first because they're all debits. They all need to be credited. Where is everything going to go into, though? It's going to go into the income summary. I can probably actually go ahead and look here and say this is going to be $1,483. Why? Because there's only expenses in here, right? There's only expenses. So I'm going to say that the income summary is going to be a $1,483. You guys see where I got that? It's the same number that we used. It's the same number that we used to calculate out our net income. We have revenues, and then we have expenses. So I can just take that $1,483, or I could add them all up. It's totally up to you. Then we're going to write out all of these expenses. So let me go ahead and do that. Advertising expense. And we're going to credit advertising expense by $460 to bring that balance to 0. Cash short and over. I'm actually just going to write them all out first. I think that'll go quicker for me. Insurance expense. Miscellaneous expense. Supplies expense. And utilities expense. And now let's credit all of these accounts. Cash short and over was only $6. Insurance expense $125. Miscellaneous expense $189. Supplies expense $153. And then utilities expense is $550. And you know, if I really wanted to, and I wanted to triple check my work, yeah, I can go ahead here, throw in the calculator, and say, all right, let's add up all these expenses that I just wrote down. 460 plus 6 plus 125 plus 189 plus 153 plus 550, and I get 1483. So if I'm sitting here, you know, not really trusting that expense number, even though the computer put it in, but just checking everything over, you can always go ahead and do that. So now I have my sales that's been Pac-Maned up into my income summary. I have all my expenses that have been eaten up into my income summary. Now, what's going to happen is that my income summary is going to be eaten up by my capital, okay? So when we look at this here, the question is, what's the balance of my income summary right now? Well, my income summary has a credit of $2,160 and a debit of $1,483. And if I would look at this, I can see that I'm going to have a credit balance, and I can figure out the difference between those. So let's just do that real quick. 2160 minus 1483. What does that equal? It equals 677. What's that really similar to? Well, not really similar. It's the exact same thing. The net income, okay? Because essentially that's what we just absorbed. All the sales and all the revenues. So if we have a credit balance of 677, we have a credit balance of 677 for our income summary. What must we do to bring that income summary down to 0? We must debit. We must debit the income summary by 677. And where's this going to go into? This is going to go into Connor Whitney Capital. So this capital account's going to eat it all up. So if income summary is going down here, our accounting equation must always be in balance, right? If we debit something, we must credit the other one. Connor Whitney Capital is going to increase or credit 677. And the last thing that we must do is we must bring our drawing account down to 0. So the drawing account, if we look over on the balance sheet, because that's where this one's going to be. Let me just move it over so you can see it. So if we look at the balance sheet, and our drawing account has a debit of $1,700. So if it has a debit of $1,700, that means it must be credited $1,700 to bring that drawing account down to 0. So we always write in the debit first. And once again, we just said that drawing had a debit balance. So drawing will be the second one. It'll be capital. But Connor Whitney's capital here is going to have to be debited. Okay, so I'll write Connor Whitney's capital. It's going to be debited. That's $1,700. And then Connor Whitney drawing. Connor Whitney's drawing here is going to have to be credited $1,700. Why is it credited $1,700? Because we're bringing that drawing down to 0. It's a temporary account. So, looks like drawing would have been brought down. I think we're okay here. All right, let's grade step 1. And we're good. 3 out of 3. Okay. I will move on to the next step here. I'll move this up so you can see it. Okay. Now, the last thing that you need to do here, get that out of the way. Last thing you need to do is post our closing entries. So everything up from sales is going to need to be posted into the correct account. So you'd go into sales here, and essentially what you're doing is you can put in the date, which is going to be the 30th, and it's already sales, but the post reference is going to once again go back to page 8, right? And this is the general journal, so it'll be G8. And what is our sales? Well, in our closing entry, we would debit it to 2160. Okay, so debit 2160. And now what's our new balance? Our new balance is going to be 0. So we're going to put in 2 zeros. Let me just hit grade this step, okay? We're going to go back to post reference, put in account number 410. So that's what you're going to do, right? You're going to do the closing entries that you would normally do. All right, and you guys have posted to the general ledger before, so I'm not going to go through and do every single one because the video is already at 35 minutes, and I want to respect your guys' time. Let's just grade this step, though, to make sure that these zeros are both supposed to be in there, because I don't know how the computer will actually grade it. So if you look here, obviously that one's correct. And then if we look at sales, let's just go down to the one that we did. Here we go. Okay. So you can see the answer here for sales, and this is correct. They want us to put zeros in both columns. That would make sense to me. I just want to make sure that they're going to count it correctly, right? So you can see that we wrote in the 30th, G8 as a reference for journal number 8. We debited that amount. It had a previous credit balance of 2160. The new balance is 0. And all of our temporary accounts should end at 0. And if we look at this up here, right, like what accounts will end up at 0? Well, sales will, right? Income summary eventually will. All of our expenses will end up at 0. Okay, so all of those accounts and drawing, they will all end their balance at 0. So go ahead, jump into the ledger, jump into posting into the ledger here. And once you're done with that, go ahead and do the rest of the working papers. Application problem 8.1 is randomized. So you're going to do one of those. You don't have to do all three, but just do one of them. And then application 8.1 static. So we really get practice on this. There's only 2 concepts. I want to make sure that you guys understand it 100% fully. If you have any questions for me at all, please let me know.